I want to talk about different asset classes, starting with what is asset allocation. Globally, we have heard that investors should have a 60-40 portfolio, 60% being investment to equity or equity like instruments, 40% being investment to debt or debt like instruments. What part does risk play in defining asset allocation?
Sure. Let me just start with what is asset allocation. I think simply put, asset
Sure.
allocation is how widely or how is your net worth distributed across asset classes. So if you have 100 rupee net worth, then according to what you said, like 60 goes in equity, 40 goes in debt. But there are more asset classes like equity, debt, gold, real estate, cash, FD, so on and so forth. So this is the diversification across assets, which is called asset allocation. Why is it important? Asset allocation is very important to do two things. One is managing risk, and two is maximizing returns. And because see the asset classes, the same asset class doesn't behave similarly across time spans. In fact, I think Mint used to do this lovely piece of a matrix. Yeah, so it was end of the calendar year where the last decades, how different asset classes would perform over the last decade. So imagine like a 10 by 10 matrix. So 2014 to 2024 on the x-axis and all the asset classes on the y-axis. And that matrix was, I loved it because what you could see in that matrix was in no two consecutive years, the top quartile of the asset classes which performed really well and the bottom quartile which performed really bad would be the same. Okay, so asset classes behave differently over time, and that's why it is important, at least for common investors, to be invested in all asset classes and do that asset allocation.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.